right, everyone, let's get started. This is Bruce Westra with Basics with Bruce for Courtney Smith and WealthBuilder LLC. Today I'm presenting the last of 3 basic futures presentations, and today the session is going to be on risk management for futures. I have to say that these sessions have been very, very interesting for me, and from what I understand, they've been interesting for you. So I think we're going to keep on presenting these things, if that's okay with you guys. So as I said, today's webinar is all about risk management, and I'd like to again thank you for showing up and making these things a success. And I just wanted to let you know that next week I'm planning on doing a webinar, a Basic with Bruce webinar on shorting. So that should be interesting as well. So let's see. I just had a thought of a new motto for Basics with Bruce. Here it is. The more we know, the more we grow. How does that sound to you guys? Anyway, let's get growing. As usual, we start with a disclaimer. So take careful note and read carefully. And you guys are all speed readers, so moving right along. Risk management. So we can ask ourselves, what is risk management? Well, one way to think about it is to think of it in terms of how we are allocating our assets. And in this case, the assets that we're allocating is our account equity, our trading account equity, specifically our futures account. Another way to think of it would be position size. When we think of position size, it implies some unit of measurement. So when we're able to measure it, position size then becomes something that we can measure. And we always say that when we measure something, then we can control it. A little story about myself. I grew up in the trades. My dad was a master carpenter and home builder, and I worked for him for quite a number of years when I was younger. And he would always say, measure twice, cut once. And he was showing me a form, by saying that, he was showing me a form of risk management or asset allocation, because he had allocated, for instance, a certain amount of trim boards to trim out a house. And if I wasted those by cutting them too many times, then he would end up with a negative position. He had to buy more. So in our terms, that would be a losing trade. Or if I really messed it up, it would be what you could call a carpenter's margin call. So to measure, or I'm sorry, to control our risk, we have to measure it carefully. And we want to remember that our risk management is based on the percent of our account equity at risk per trade. So when we start to look at risk management, we want to focus on limiting our risk per trade. So in other words, that means each individual trade we want to look at and limit the risk on that trade. We can't be sloppy and let some trades have no risk management while others, we look at carefully. So we need to look at all of them. When we control, and Courtney says, capital preservation is more important than capital appreciation. So control of position size equals control of risk. So here I have a chart that says update risk management daily. So what do I mean by this? Well, let's take this chart, for example. It's a chart of the ES or the S&P 500. And if we can look at the right-hand side, the upper right-hand corner, we see a number of bars that are approaching a channel. And let's say, for whatever reason, we were interested in doing a channel breakout type trade. And we look at the chart, in the September around the 11th, 12th, something like that. And we get excited because we see, hey, the bars are getting closer to the channel. So let's measure our risk management so we can put a buy order in. So we wait our 5 days for the 5-day condition to start to measure our risk. And we see that around the 20th of September, we're interested. So we do our risk management, calculate our position size. Then a few days later, the market trades down and our risk increases. So we need to take the trade off because it no longer fits our risk parameters. In other words, there's just too much risk to fit inside our risk parameters. So then in the beginning of October, it trades up again. So again, we say, hey, we're starting to get excited again. So we start to, again, recalculate our position size. And lo and behold, it starts to fit within our risk parameters. So we put the trade on, and now we have the trade on, and we're just waiting for a breakout. But my point is that every day since we made the decision to put a trade on, we recalculated our position size because the risk increases and decreases, and we want to make sure that it fits within our risk parameters. So that's what I mean by updating the risk management daily. As you know, if you've been watching these webinars with me, you will know that there's always two ways to calculate things, and specifically calculate position size. And you know what they are before I say it. The hard way and the easy way. And there's Mr. and Mrs. Easy in the pool, relaxing after doing all of their trade work. So as usual, we always start with the hard way. Here's some hard way calculations for calculating risk management. Just a second here, I'm looking at this. Okay, good. So position size calculation number 1. And you can read these as well as I can, but I'm just going to read them for you. So we have the entry minus the stop loss times the multiplier equals the dollars risk per contract. Now this particular formula or calculation shouldn't look too unfamiliar to you. Basically, it's the same as the Forex with a couple changes. The multiplier being the main one. What's the multiplier? Well, I'll talk about that in a minute. The other difference is instead of risk per lot size, we have risk per contract. So position size calculation number 2. Account equity times the risk limit percentage divided by the risk dollars per contract equals our position size. So to get back to the multiplier, what is it? What does it do? Primarily, what does a multiplier do? To answer that, we need to go back to the futures specification charts that we discussed in the last webinar. here's an example of a futures specification chart, and there's a ton of data jammed in there and hard to read. So if we just want to look at wheat, I pulled that one out, and we see that wheat, we see the wheat, the symbol, the months. Then we come to tick size. And we know what a tick size from last week. It's the smallest incremental size that a futures contract can make. And for wheat, each tick is 1/4 cent per bushel, or the tick value is $12.50. The quoted units are US dollars per bushel, and one trading unit is 5,000 bushels. So one wheat futures contract represents 5,000 bushels of the grain and is quoted in 1/4 cents per bushel, and the tick value for each tick is $12.50. So that gives us, for a 1 cent price change, that would be worth $50. So the multiplier then is 50. It's basically, a multiplier is one price movement of the quoted currency. So it's $50, so the multiplier is 50. So 100 of those movements would So the multiplier is what produces leverage a futures contract. That's the purpose of a multiplier. That's what it does. Position size calculators, and you'll see a number of different examples. You'll have to poke around a bit. Some of them, when I looked, I liked some of them I didn't. But you'll have to poke around and see the ones that you like. You can also ask your broker if they have a position size calculator. Global Arena does, so you might call Bob Kane and ask him at Global Arena. The not quite so easy way is to create a position size calculator on an Excel spreadsheet. So you just take all of the components of the equations and make sure that there's a column for each one, put the formulas in, and basically that's how you do that. I'm no Excel spreadsheet genius. I'm not going to have a webinar on it, but those of you who are can help those who aren't. So ask around amongst yourselves, chat amongst your friends, and I'm sure you can accomplish that. This, to give you a little hand on that, these are some of the futures instruments that I trade and the multipliers that I use. And I have to tell you that the multipliers I got from Interactive Brokers. These are the multipliers that they use. Your own broker may very well have a position size calculator for you that he can hook you up with, and he may use different multipliers to figure those out, because he may use different formulas. However, these are the ones that I use. Homework. Homework is practice using the hard way to calculate position size. You can use my multipliers to do that. or your broker's multipliers to do that. And the second part is find or create a position size calculator. And the reason for that is if we do the math the hard way for each trade that we're in, sooner or later we're going to make mistakes, and we don't want that. That's not executing flawlessly. And when you have a position size calculator set up and working, the odds of it making a mistake are slim to none. The third part of the homework is never enter a trade without knowing that the position size of the order is within your risk limit parameters. So that's the homework for next week. I'll take some questions and remind you that next week is shorting. So I'm looking forward to that, and I hope you are too. Let's see. Someone says, Bruce, many of us will be at Courtney's Futures and Forex course. And can you postpone the short course for 1 week? Well, I don't think I'm going to postpone it. However, it will be posted on YouTube, and you can see it there. And thanks for going to YouTube, by the way. We're getting more and more hits. So tell all your friends and visit it yourself. So Jane, that's where it's going to be posted. Let's see. Yes, Tanya, I'm going to be in LA for the How to Make a Living Trading seminar. So I hope to see you there. Let's see. Can I show the homework again? Yes, I can. I can do that easily. Am I still going to do a series on pro real-time charts? Yes, I am. I haven't quite got my wits wrapped around how I'm going to divide it up. Maybe you guys could write in to my email address and give me your ideas on that, and I can always take that into consideration for how I split that up, because it is kind of a technical, lengthy subject. So, all right, everyone. Well, that's all for this week. I got to jump. See you next week for shorting. Bye now.